Clay Patton on the Rural Radio Network, and now it's time to take a check of the weekly commodity trade with Darrell Holaday, Country Futures in Frankfort, Kansas. Darrell, it's kind of been a wild ride this week, plenty of macro market factors and influences impacting the trade, but looking out on Friday, glad to see wheat is back in the green, bringing corn along with it. Is there any hope, though, that this will be followed through to next week, or are we looking at still a dismal or pressured commodity market?
Well, I think in the big picture, it's probably, in the long term, it is a rollover. We've rolled these markets over, and we've talked about this, that we're going lower. But I do think maybe corn, for example, would be the one that I'd pick out that maybe hits some levels this week that have some, certainly represent some commercial value. And also, what it's done is it got down to levels that you say, hey, this window of opportunity to export some corn, you get low enough price, you'll get some U.S. corn out the door, although it was not a very good week from an export standpoint as a whole in the picture. But in it, wheat, same general way, I'd still think that the world wheat price continues to pressure the whole entire wheat market. Now, as a whole, we generally saw, as you said, the wheat and corn under a lot of pressure, but they did come off their lows on Friday. But still a pretty humbling week when you figure that on Friday you were up 20 cents on the day, but that still left you 20 cents lower on the week in the Kansas City July contract. And we need to go back to Wednesday when WASDE came out with their updates on supply-demand projections. Generally, all the market reaction to those was generally lower across the board. It took a little bit to get there. Now, in the big picture, the positive side is they were very aggressive in lowering Argentine corn and soybean production, took the corn production from 47 million tons down to 40 million tons, and the soybean production from 41 down to 33 million tons. And that's really, even though we have that big Brazilian crop in there, now you're starting to find that, year over year, South American soybean production is probably not going to be a whole lot higher than last year. That's if those numbers pan out. Of course, there's people who also think those numbers will go lower. There's some would say, well, some late rains could push them higher. Once again, the drought concerns are there. But on top of that, and probably most importantly, is the U.S. If you really look at the WASDE deep and kind of read between the lines and do some, if you will, some calculations with some of the detailed numbers, you realize what really the WASDE was trying to tell us is that we just have weaker demand. We are seeing a weaker demand picture across the board, primarily throughout the world. I think the very best example of that is that they lowered the corn production in Argentina from 47 million tons to 40 million tons, but at the same time, very same report, they lowered U.S. corn export projections by 2 million tons. Well, how could it, in any given year, if you'd come down 7 million tons in Argentina in the month of March, you would expect a bump in that projection for corn. That didn't happen. It's because, for one, they should have lowered the U.S. export projections 2 months ago. It was very obviously we weren't going to get to where they have them. And secondly, what it represents, though, is that we're seeing a weaker demand for corn around the world because so much of the wheat, as the wheat has come down in value, is pressuring these corn values and taking it because it's moving into feed markets, which it always does. Wheat is always fed throughout the world. This year it got off to a slower start because it was at a very higher price. But once the Australian crop became available, more stuff coming out of the Black Sea and out of Russia, wheat's making it into the feed rations, and that's pressuring corn. And I think we all knew that could happen. But we did see prices move to somewhat supportive levels. As a whole, the slow economic growth and the stagflation environment that we have in the United States and the world is a negative factor, and it certainly impacted the equities this week with a big drop in the S&P and the Dow. The soybean complex continues to be the overall strength, the backbone of the market. Again, though, we saw some rollover, big losses in the soybean oil market, with that soybean oil market moving down to 55, 56 cents. There were many who didn't think we'd really ever see the market this year trade below 60 with the idea with the renewable diesel. That level's been blown out, and there's a lot of longs. The market ended up down in that 55 to 56 level, the worst close we've seen in that market in several months. On the week, May corn 617 down 23. The December corn 558.13 lower. The May soybeans 1507 down 12 on the week. New crop November 1357 down 16. The March Kansas City wheat 811 down 11. New crop July at 789 down 20 on the week. April crude 76.68, 330 lower on the week. On the livestock side, we did see a rollover in the cattle and the feeder cattle values as we saw those new midweek highs across the board in April's and April cattle and feeders. Of course, the most impressive was the move in feeders that took prices to 222, 224 area for those late summer, fall levels. Before somewhat a reversal at midweek. Once again, I think the overall economic signals were generally negative. This stagflation environment, we did get the jobs report number out on Friday that put February job increase at 318,000. That was a little better than anticipated, but we did see an uptick in the unemployment rate up to 3.6%. That gave some optimism to the equity market for just a little while that maybe the Fed could back off and cut back on interest rates, maybe just go a quarter point this month and back off or pause, or maybe not go a half. All kinds of factors out there as equity's been under pressure all week. But the bottom line, as we worked our way through those numbers, you realize what we're really seeing is an overall economic slowdown that we've talked a lot about, and that's what the became concerned about, and that's why we saw selling pressure throughout the week. So in the end, that kind of led to cash cattle on Friday being traded steady. It didn't push for higher money, but it did 165 in the south. Generally, the steady numbers also in the north. Sharply higher on the week, but all that gain came on Friday with strength in the product late in the week. Otherwise, it's pretty well a flat affair back and forth. So again, the index continues to work higher, but as we ended the week, we once again have big premiums in, for example, the April hogs versus the overall index, which is just trying to make its way up above the $80 level. April cattle on the week down 115 at 164.27. June 158.5 down 202. March feeder cattle 191.47 up 147. May feeders 203.57 down 262. April hogs 87.45 up 290. June hogs 102.77 up 210 on the week.
And that is Darrell Holaday, Country Futures, Frankfort, Kansas. Learn more anytime, countryfutures.com. Do remember, though, trading futures and options involve risk of loss, may not be suitable for all investors. Do consider these risks before investing.